All right, today we're going to tackle one of the most interesting and, let's be honest, most debated topics in finance, technical analysis. We're going to get into the core philosophy, this idea that you can actually forecast the future just by reading a chart.
So let's start with the big one, the billion-dollar question. Can you really predict the market's next move? For literally centuries, investors have been trying to find a magic formula for this, and that whole search has pretty much split the financial world into two completely different camps.
So on one side, you've got fundamental analysis. These are the folks digging into economic reports, company earnings. They want to know the why behind a price. But on the other side, you have technical analysis, and they're focused purely on the price itself and how much is being traded, the what. And that's the philosophy we're going to unpack today. So what are we really talking about when we say technical analysis? Well, at its heart, it's the study of market action. It has less to do with a company's balance sheet and a lot more to do with the raw, unfiltered behavior of the market itself.
The classic definition really says it all. It's the study of market action using charts to try and forecast future price trends. The keywords there are market action, charts, and forecasting. So let's start with that first one. What does market action even mean?
Market action is basically the raw data that technical analysts or technicians live and breathe. It really comes down to three main things: the price of something, the volume, so how much of it is being traded, and in some markets like futures, something called open interest. These three little data points are the foundation for everything else.
Okay, so to really get inside the head of a technical analyst, you have to understand the three core beliefs that this whole approach is built on. These are the fundamental assumptions that every chartist pretty much accepts as truth.
Let's kick things off with the first and, you could argue, the most important belief. And that's the idea that market action discounts everything. Now, this is a huge concept, so let's really break this down. Just think about how big of a claim this is. A technician believes that everything that could possibly affect a price, we're talking earnings reports, interest rates, political news, even the collective mood of the market, it's all already baked into the price you see on the chart. So if you believe that, the logical conclusion is, why would you waste time studying all those different causes when you can just analyze the final effect, which is the price itself?
All right, the second core belief is just as critical. Prices move in trends. This is really the bedrock of the entire technical strategy.
I love this concept. You can almost think of it like Newton's first law of motion, right? An object in motion tends to stay in motion. Well, in the market, a trend that's already underway is way more likely to keep going than it is to just stop on a dime and reverse. So a technical trader's whole job, their main goal, is to spot a trend as early as possible and then just ride that wave for as long as it lasts. And this chart just shows you exactly what we're talking about. This is the S&P 500 over almost 20 years. You don't need to be a Wall Street guru to see that powerful uptrend. The technician's job isn't to ask why this was happening, it's just to recognize that it was happening and trade with the trend, not against it. And that leads us right into the third and final pillar of this whole philosophy, an idea that really connects the dots between charts and just plain old human nature. History repeats itself. At its core, this belief is all about human psychology. The idea is that because human nature doesn't really change, people tend to react to similar situations in the market in very similar, predictable ways. So those classic chart patterns that you hear about, the ones technicians have been using for over 100 years, they're seen as these little visual snapshots of that repeating psychology, that timeless tug-of-war between optimism and fear. So when you put these three core beliefs together, it leads to this really important distinction in how technicians see the market. It all comes down to focusing on the effect, not the cause. So think about it like this. A fundamental analyst is like a detective, digging through all the clues, the balance sheets, the economic data. That's the cause. They're trying to figure out where the price should go. A technical analyst, on the other hand, just looks at the chart, the effect. They believe the net result of all those fundamental forces is already right there in front of them. It's just a more direct, more efficient way to get to a forecast. Now, of course, not everybody buys into this. This approach has some serious critics, and probably the biggest challenge comes from a pretty powerful idea from the world of academic finance. So let's just tackle that one head on. This is the random walk theory. And in a nutshell, it says that price movements are totally random and unpredictable. What a stock did yesterday has absolutely no relationship to what it's going to do today. So that makes looking at past history completely useless for predicting the future. And if that's true, well, it basically blows the entire technical approach out of the water.
But, let's put that theory to a little visual test. I want you to take a good look at this next slide and just ask yourself a simple question. Does this look random to you?
So this is a chart of gold prices over 2 years. Someone who believes in random walk would have a pretty tough time trying to convince a chartist that there isn't an identifiable trend here. Yeah, there's a lot of choppy noise day to day, but the overall direction is clearly down. Technicians would argue that while markets aren't perfectly predictable, they are a long, long way from being totally random.
Okay, so what's the other big knock on technical analysis? It's this idea of a self-fulfilling prophecy. This is the argument that a classic chart pattern only works because enough traders see it, they all believe it means the same thing, and they all act on it at the same time, which then causes the very move they were predicting.
But the counter-argument to that is pretty compelling, and it's that charting is super subjective. It's much more of an art than it is a science. Seriously, if you showed the exact same chart to 10 different analysts, you could easily get 10 completely different interpretations. And since there's almost never this universal agreement on what a chart is saying, the idea that millions of traders are going to act in perfect harmony to create a prophecy, it seems pretty unlikely.
So let's start to wrap this up by talking about one of the greatest strengths of the technical approach, and that's its incredible flexibility. You can almost think of it as a universal language for all markets.
Because technical analysis is just based on price data, which is really just a reflection of supply and demand, you can apply its principles to literally any market anywhere in the world. Stocks, futures, crypto, you name it. Here on the left, you've got the US stock market. On the right, the Japanese stock market. The companies are different, the economies are different, but those patterns of human behavior, the trends, the formations, they look awfully familiar, don't they?
So, we'll leave you with this final thought. What if the real value of technical analysis isn't about some magical power to predict the future? What if a chart is less of a crystal ball and more of an X-ray, a picture of human psychology in action, showing us that eternal dance between hope, fear, and greed?